The banking regulator wants to make it more difficult for you to get a mortgage in 2025. Here's the what, when, why, and how. The Globe and Mail reported per anonymous sources that OSFI is introducing this new rule that will limit the number of mortgages that a bank has on the books where the loan amount exceeds 4.5 times a borrower's income. This will be introduced in the first quarter of 2025. This is really a preventative measure to protect banks from over-leveraged borrowers if and when interest rates come down in the future. Back in the good old days during 2020, 2021, when rates were so low due to the pandemic, borrowers were able to qualify for roughly 4.25 times their household income. So per $100,000, you could easily qualify for about $525,000. And that was due to low interest rates. Today, interest rates are much higher, so borrowers are only qualifying for roughly 4 times their income. But the worry is that as interest rates come down, borrowers will be able to qualify for more and more debt, which could lead to trouble in the future. At this point, we don't know exactly how the new rules will be implemented by banks and regulated entities, but we do know that basically once interest rates come down to approximately 4.5%, the new rules would trigger. And most likely, the banks will then have to start introducing new, more restrictive qualifying criteria for borrowers that want to exceed the 4.5 times their income. Now, if there are 2 things that I want you to remember about this video, it's the following. Number 1, the new qualification rules or this LTI metric will only come into play if and when mortgage interest rates drop below 4.5%. And number 2, banks can still lend over 4.5 times a borrower's income. They're just going to have to limit the number of borrowers that they take on over this threshold and really have to introduce new qualifying criteria for borrowers that take on higher debt. So what do we expect to happen with the introduction of these new LTI metrics to qualify for mortgages? Well, it's really a prohibitive measure to keep house prices down. And we have a great example of this back in Ireland in 2015, where similar LTI metrics were introduced. And ultimately, the result of that study and that experiment showed that the amount that borrowers could qualify was diminished, and therefore it suppressed and kept housing prices low. I think that's something that's really important. Obviously, there's a lot of political will about keeping housing affordable for Canadians, and this is one of the tools to do that. My name is Chris Mulder. I'm a Toronto mortgage broker. I'm really curious to hear how you think the new LTI metrics are going to impact Canadian real estate. Leave me a comment. Be sure to like and subscribe. Till next time, bye for now.